On Wednesday, June 24th, spot gold remained deeply mired in mud during the Asian morning session, following yesterday's dramatic high-altitude plunge of over $81, pummeled by the Federal Reserve's aggressive interest rate hike expectations and renewed uncertainties surrounding the fragile U.S.-Iran peace pact. Gold suffered a technical breakdown. Prices officially severed the critical support at $4.100 per ounce, hitting an intraday low of $4,050 and locking in a firm short-term bearish trajectory. From a fundamental perspective, the market continues to process the ultra-hawkish signals broadcasted by newly appointed Fed Chair Kevin Warsh. Bets on a December rate hike have skyrocketed to 86%, with some Wall Street megabanks going so far as to project 3 rate hikes this year. This hawkish momentum propelled the U.S. dollar index DXY to a more than one-year high of 101.39, with the powerhouse greenback exerting severe tactical pressure on non-yielding bullion. On the technical front, having successively surrendered the key psychological milestones of $4, $200, and $4,100, the daily chart exhibits a textbook bearish alignment, although the relative strength index RSI indicates that the market is hovering in deeply oversold territory. The lack of a definitive bottoming signal means gold is highly likely to prolong its weak, downward sloping consolidation. For today's session, the core defensive line on the downside shifts lower to the $4.20 or $4,050 zone, representing the swings carved out in early June. Should this area fail to hold, it could expose gold to a deeper routing towards the $4,000 psychological baseline. Conversely, initial overhead resistance has structurally flipped into support-turned resistance at $4,120, with heavier resistance sitting at $4,160. Ahead of Thursday's high-stakes U.S. core PCE inflation print and GDP data dump, market sentiment remains highly fragile. Intraday traders are advised to maintain a sell-on rebound stance and avoid blindly catching a falling knife. This content is for reference only and does not constitute investment advice. Trade at your own risk.